Give us the big picture here. Talk about the US economic performance in 2025 and what it means for global growth, especially for major trading partners like China.
That's a good observation. In fact, 2025 has been volatile. We had actually a negative growth in the first quarter, then it picked up in the second quarter and the third quarter. However, when you look at the pattern of imports in particular, which is what matters for in terms of trade with the United States, imports spiked in the first quarter in anticipation of the tariffs. A lot of those imports went into inventories, and then for two consecutive quarters, imports have declined. So imports are at a level now near 3.6 trillion, which is still a good level. It's about the same level as the first half of 2024. But the overall picture in terms of exports to the United States is not particularly constructive right now.
Right. And inflation has cooled, but interest rates remain high. How is the Federal Reserve's higher for longer stance shaping the US economy?
Well, I think that the Fed is actually kind of in a situation where they have to walk this tightrope between the fact, as Powell has mentioned, that prices are tracking higher than their target. Some of that is due to the tariffs. But on the other hand, the employment situation is not particularly good. I mean, if you look at employment numbers, really overall, they've been flat for most of 2025. And there's been a lot of reduction in employment in small and medium sized enterprises. There's three consecutive months of declines in employment in small and medium enterprises in the last 3 months in September, October, November. So that's not a good sign. If the small business sector is under stress, then that's going to have a negative impact on employment prospects, and that's what the Fed is worried about.
And US equity markets have held up well, driven largely by big tech and AI stocks. Can you talk a little bit about the concentration risk here?
Well, in the U.S. equity markets, as you know, have been also been up and down rather radically. Particularly, there was a significant correction in April after the reciprocal tariffs were announced at a very high level. Then, as those tariffs were walked back, the equity markets recovered. Then they started to think, well, maybe the situation in terms of the tariffs is not as bad as what we expected. The other positive in terms of the general S&P 500 is particularly the large corporations. So you have to distinguish between the large corporations and the small corporations, small businesses. But large corporations have been amazingly adaptive in terms of dealing with the tariffs. In other words, some of the tariff costs they've absorbed in terms of lower operating margins. Profit margins went down and have been flat in the second and third quarter, and they stopped hiring people. So they've been able to control their costs by those two devices. However, so that's kept the corporate profits. The corporate profits rebounded in the third quarter. They've been surprisingly resilient because of the factors I just mentioned, but it comes at the cost of no employment growth and, in some respects, some really disruptive shocks to the planning process with businesses in terms of planning for 2026. As I said, on the other hand, with the small business sector, we see that profits in the small or income of the small business sector is basically flatline. So they have the small business sector is not doing well. Large corporations are doing well. That's why the S&P 500 is doing well.
Right. And given the resiliency you speak of, we have these high prices. It is the holiday period, and the US consumer seems to be fairly resilient. When we factor tariffs in, can we expect more uncertainty? And when will we see Trump's tariffs really start taking effect on the US consumer, which appears to be quite resilient for now?
That's a good point because, as I said, a lot of companies absorbed a big percentage of the tariff, and I estimate around 75% of the tariff costs were absorbed on operating margins, and only 25% was passed on. Where we're seeing the tariff costs now is specifically when you look at equipment and software prices, which have been going up at a very rapid rate. So the tariffs are now impacting the input costs in terms of investment goods. And as those investment goods are bought by other companies, those will start to push prices up. So we're nowhere out of the woods in terms of the problem of tariffs. Bottom line, when you look at investment in the third quarter, it was flatlined. The reason why it was flatlined is not because there wasn't spending. There was spending on investment goods, but the prices of investment goods went up significantly. So on net, there was no increase in real spending on business investment. So that's not a good sign. If you're not investing in the capital stock of the economy, that will have negative consequences for productivity over the long run.
And looking ahead, what are some of the biggest challenges, not just for the economy, but also for the markets, do you think?
I think at this point, the markets are, in some sense, now kind of consolidating. They had a volatile year. It was extremely negative in the first quarter through April, and then it rebounded. So the problem will be looking at 2026 as we enter the new year, we're going to see evidence, more evidence that the underlying growth of the economy is probably closer to 2 to 3%. And in addition to that, the inflation numbers are starting to show more positive in terms of dropping below 3%. So that configuration of slower growth, low employment growth, inflation coming down does give the FOMC at least some possibility or a window to reduce rates further. So I think the Federal Reserve could reduce rates by 25 to 50 basis points further in the first half of 2026, and that would benefit the economy, particular households, and of course small business, where small business is borrowing at the prime rate. Prime rate is 3 percentage points over federal funds. So the small business sector particularly would benefit from lower interest rates by the Fed.